to have you on board. Let's get in your take then as to what exactly is happening within the entire metals basket. Looking at a lot of fervor building up within this space. What's the rest of the year hold in store?
Yeah, good morning. Well, I guess on one side, demand scenario remains absolutely upbeat and convincing. On the other side, the energy cost also, I think, remains by and large under control, largely because of the fact that whatever I think the crude oil prices behavior has been, despite of all related situation, I believe that I think the crude oil price has remained quite subdued in a way. So from that perspective, I think we haven't seen any kind of a sharp increase in the energy cost for the metal commodity companies. Given the fact that on one side you have a steady demand scenario, on the other side in the stable what you call energy prices, the business condition remains, I think, extremely favorable for some of the companies like Tata Steel, where they have been successful with the kind of numbers as well from the point of view of higher production, as well as, I think, better realization and the profitability. The sales numbers, I think, require to be looked into with a little bit more of a microscopic lens. Largely the fact that I think there probably the low yield rate products, I think, are still dominating the portfolio of the company. Whereas I think the higher value addition products, I think, which are in the specialty branded segment within the steel sector, I guess I think is something which probably I think is giving the edge to companies like ArcelorMittal or for that matter even Tata Metal, Tata Steel. They probably remain relatively more safer, better as far as I think the approach towards the valued product is concerned. And that's where probably you differentiate the business in your portfolio while adding the stocks into your portfolios.
Deven, hi, morning. Would you be adding fresh defense names to your existing portfolio or even, fresh buys for that matter, looking at how HAL's strong performance has been, the way some of these names like a Mazgaon, Cochin Shipyard, etc. have been performing off late and, to top it all, BEL's numbers as well?
Yes, absolutely, Asha. I believe that the numbers are really clearly supportive. And on the top of it, you are seeing the visibility of next 3 to 5 years as far as the order book is concerned. So that is not a question mark out here at all. Given the thrust of the government in building this entire space, including railways, including defense, I think in a systematic manner, wherein Make in India manufacturing base, I think, is expanding. I believe that the companies would have the regular flow of orders at the same time have visibility of executions as well. Uh, Overall, I think these companies of late in last 3, 4 quarters have been also suggesting that their profit margins are stabilizing. Unlike in past when the government used to possibly needle the orders and I think would probably control the profits of the companies. Out here, I think the government is allowing these companies to earn the revenue and the profit both, I think, from the business, even though government is the main buyer. Still, I believe that I think this is where the companies are relatively better placed. Maybe the valuation wise, they are not little bit comforting at this point of time. Maybe the collective market would be a better choice. But at this point of time, as we talk, I think the market is full of momentum. So the correction of a sharper degree, at least in the near future, is not looking in place. Maybe I think we'll have to wait for it to longer to add some of the quality names, or maybe the ecosystem within this defense space. I think would be the ones one should be adding into the portfolio going forward.
Okay, we'll also be watching out for delivery and trade. CLSA has downgraded the stock to an underperform. They slashed the target price to about 488, saying that the revenue growth has been below street expectations. What's your view, Deven, not just on delivery, but some of these other new age tech companies, the kind of earnings performance that they have been delivering?
Uh, Overall, I think the growth prospects remains absolutely convincing. And to a greater extent, I think the earning performance is also suggesting that the growth and the momentum both are helping them in the marketplace. The question would be about the valuations. In my viewpoint, I think I am not fully convinced about I think paying very high valuation to some of these companies, even though the growth is on their side, largely because of the fact that in this market there are plenty of other opportunities which are available at prospects of I think giving you better return, and at the same time the valuations are not so very expensive. When we look at I think the BFSI space alone, I think you find that plenty of companies which are growing at a very fast pace At the same time, I think the valuations are not expensive. Similarly, the situation in I think Nifty 50 companies, wherein some of the large cap companies are available at not so expensive valuation. So my only question about I think the higher valuation in chasing those new age companies would be not to pay significantly high amount of valuations to those companies. Vis-a-vis that, I think the conventional model where the growth rate is steady and the business condition looks reasonably good, I would buy margin of safety and buy, I think, some of the moderated valuation companies at this point of time in the portfolio.
Right. Okay, some analyst meet takeaways as well. In Fusion Microfinance, the management is expecting NIM expansion to continue in FY25 as well. Gaurav is here with the takeaways. Gaurav?
Well, yes, Fusion Microfinance held its analyst meet, and if you look at the commentary came up from the management, it is actually quite positive from the company. So first, let's look at some of the guidance that the company has given, which are actually crucial from here on. So management is now guiding AUM growth somewhere in mid 20s for the next 2-3 years, and at the same time, they are also expecting management over it to remain somewhere around 1 to 1.25 percentage versus what it is right now at 0.6%. Apart from that, they are also eyeing for an ROA which is going to be somewhere around 4.7 to 4.9%, which is again going to be positive for the company, and ROA is also going to be around 18 to 20%. Management from here on is guiding credit costs to remain somewhere around 2.6 to 2.8%, and they are also expecting NIMS expansion that we are seeing right now to continue in FY25 also. From here on, they're also expecting they are going to focus on liability franchisee diversification. They are going to reduce their dependency on the bank term loans, and they are going to replace this with debt instruments. Apart from that, we have also seen that the Fusion Microfinance has been expanding its asset base also. So they already have MSME segment. Now they are going to look into affordable housing segment also, and they are going to also looking to build a full scale dedicated collection vertical in MFI zone. And lastly, they are also not disbursing any kind of loans in Punjab right now. They will be looking and taking a call post elections, but for here on, for at least for now, they are being a little cautious when it comes to regions like Punjab. So all in all, a positive commentary has come up from the management. They are given a crucial guidance for FY25 and for the next 2-3 years. On back of this, we will definitely watch out for how it turns out for the stock price of Fusion Microfinance from here on.
All right, thanks very much for giving us that heads up. Meantime, Deven, let's get in your take as to what the outlook is when it comes to the entire banking sector as well. The index is about 3.7% away from life highs. How are you looking at some of the large cap banks and their performance? Are you very selective here?
Yes, need to be selective, but at the same time, I think these banks are available at compelling valuations, as I would call it as. Look at the likes of Kotak Bank, look at the likes of HDFC Bank, where the size is also there, business outlook is also, I think, extremely proper. Their management of the NPA has been, I think, one of the better of the lot in their space. Yet these banks have not given appreciation to the investors. In my viewpoint, I think this kind of valuation, when they are neglected, they give you, I think, a long-term opportunity to buy into your portfolio. I believe that I think that's where probably when the market is neglecting the quality growth, then in that case, I think one will have to buy this kind of companies. Today, the behavior of the market is largely momentum driven. And I believe that I think the first principle that one has learned is that I think never neglect the value. I think momentum will eventually follow. So from that perspective, I believe that likes of Bajaj Finance, likes of Kotak, they are looking some of the smartest of the lot within the investment portfolio, which one can possibly add into.
Then, if I look at the FI positioning in the market, it is at a 12-year low. DI positioning, retail positioning at the market, almost at an all-time high. Now, let's assume that market could have a swing because FIs are saying that we want to hedge. They are worried about the election portfolio or election verdict. DIs and retail is of the view that the continuity will increase and markets could see a rally on the election verdict. If one assumes that there is a rally on the election verdict, is it time to buy FI dominated stocks because that's where the reverse is going to be sharper, which is that rather than buying PSUs, defense, railways, which are the obvious beneficiaries of continuity, the scare actually will happen within the FI community because they are the ones who are short.
Yeah, Nikunj, good morning. A pertinent question, I think. Well, I think on one side, if you see the behavior of the FIIs, I think they have been basically ETF and index fund players. So obviously, I think they have been driven largely by the momentum, and not momentum alone in India, but at the same time, I think where the other places of the world they could swing the value of one investment. Recently, I think they have started shifting part of their money to China, largely because of the underperformance of Chinese market. They want to bet against that underperformance. In India, definitely, I think that part of the weightage has been reduced because most of the stocks have been priced to perfection on the valuation side. So they have been out here in the domestic market, the investment funds, the AMC included, or the PMSs and the AIS and the insurance companies, they all have been, I think, buying systematically into some of the quality areas, the sectors and the companies therein, largely because of the fact that I think the growth rate is behind them. Today, I think most of the manufacturing space dominated by the railways, or for that matter, defense, or for that matter, capital goods infrastructure. I guess I think they have probably significantly high amount of tailwind of growth, which is pushing them. And I believe that I think domestic industry is making right choice. Though the valuations are expensive in some cases, and maybe I think one will have to buy when the valuation gives you an advantage. The momentum with the flow of money coming into the PT of AMCs and insurance companies, which is compounding at around 20% rate of growth, is something which is very, very significant. And that's where probably I think they are selecting the right term in my viewpoint. I think India is a story for next 10, 12 years, wherein I think you will have to buy some of the long-term oriented stocks, and you will probably make a huge amount of return in this 10, 12 years time, given the kind of compounding power effect that you will get in your portfolios.
Okay, stay with us, Deven. Let's move right on and
Commentary from Bharti, and if you try and read in between lines, it appears that a rate hike or a tariff hike is round the corner.
And Nikunj, I think they are making a huge amount of I think noise about creating the higher amount of tariff hike. In my viewpoint, I think while the 5% kind of a tariff hike is not ruled out on a year-over-year basis, I think that is not something which I would be against. But the fact that I think if we are expecting a very sharp rise, then probably expecting thereafter that I think this company will be able to pass it on. To me, I think that doesn't appear to be, I think, a very convincing argument. Rather than that, I think I'm more convinced about, I think, the use case which are getting built into in the entire universe, which is leading to the data consumption, higher data consumption. If earlier period of time, I think the higher amount of video kind of a consumption happened in the entertainment space, that continues. But today, I think more and more use cases are getting developed in different other industry verticals, be it in e-commerce, be it in gaming vertical, be it in the agri vertical, and so on and so forth. So from that perspective, I think if you keep the entry fee little lower, but higher amount of data consumption takes place. So on one side, I think the variable would be the data vis-a-vis the price, which I believe I think is a fundamental way to go. And I think that is where Geo kind of company has been systematically positioning itself. On one side, they have got the fiber ducted in the ground. On the other side, I think they have got the higher amount of bandwidth available on the RF side. So from that perspective, I think it's a combination of beautiful amount of data bandwidth offered to the users. And that's where I think they score an edge probably. I think that Vodafone Idea kind of a company will have to be significantly investing into the front-ended expansion or the expenditure that they will have to create, both in form of I think the ground infrastructure, in form of I think the fiber optics, and also in form of the spectrum which they have, which they will have to I think slow gradually but systematically roll it out towards 5G. If that does not happen, then probably higher amount of revenue coming into the balance sheet and then the profits. I'm a little doubtful. In fact, my rate is that I think this one expansion which is completing debt equity combined of 45,000 crore. The next expansion could be, I think, or the next requirement of capital could be in next 1.5 to 2 years time easily, if they have to actually catch up with where they have lost the ground. So I'm a little bit more skeptical. I would rather allow things to happen, I think, one at a time, not immediately would start visualizing everything in favor of this company.
okay, Deven, thanks for joining in. Good to have you on board with your take on the markets.
If you like this video, then like, share and subscribe to ET Now.